For about a decade, the most striking thing about the biggest technology companies wasn't how much money they made, it was how much they had left over. Cash piled up faster than anyone could think of uses for it, so much that the main strategic question became what to do with the surplus, and the answer was usually to buy back their own shares. These were businesses that had solved the problem of needing money. That era has quietly ended. The tech sector is now expected to raise something in the region of $1.5 trillion in new debt over the next 3 years. Not to rescue anything, to build. Start with why, because it isn't distress. Building the infrastructure to run modern AI is enormously capital intensive in a way software never was. For 20 years, the defining feature of a software business was that scaling cost almost nothing. Write the code once, and each additional customer was nearly free. That's why these companies became so profitable in the first place. AI breaks the pattern. Each new user consumes real compute, real electricity, real cooling. The economics have shifted from publishing towards something closer to heavy industry, and heavy industry has always run on borrowed money because the plant has to exist before the revenue does. The scale of that shift shows up in a statistic that should be better known. Bonds issued by the biggest cloud and platform companies recently accounted for something like 30% of all net investment-grade issuance in the United States. 3 in every $10 of new high-quality corporate borrowing going to a handful of technology firms. Those same names doubled their share of the investment-grade bond index inside a single year. That number matters for a reason that has nothing to do with technology. There is only so much appetite in the world for investment-grade corporate debt. Pension funds and insurers have to hold a certain amount of it, and the supply they buy is finite. When one sector suddenly absorbs a third of new issuance, everyone else, manufacturers, utilities, retailers, hospitals, is competing for what's left, at prices set partly by how much the technology sector wants that month. The AI build-out has become a factor in the borrowing costs of businesses that have nothing to do with it. Public bonds are only the visible half. Alongside them sits a private credit pipeline estimated at around $800 billion, arranged by firms most people have never knowingly encountered: Blackstone, Blue Owl, Apollo, and their peers. Private credit means loans that never touch a public market, negotiated directly, held by funds rather than traded, and disclosed far less than a bond would be. It has grown enormously since banks pulled back from this kind of lending after the financial crisis, and it is now a central pillar of how data centers get financed. It helps to know what the money actually buys, because the mix explains why the financing looks the way it does. A large AI data center splits roughly into 2 very different kinds of spending. There's the building and its systems: land, shell, power connection, substations, cooling, which behaves like traditional infrastructure and lasts for decades. And there's the hardware racked inside it, which is the majority of the cost and has a useful life of a handful of years. That split is awkward for a lender. Property finance normally works because the asset outlives the loan. You can repossess a building. Repossessing 3-year-old processors is a considerably less attractive proposition because their resale value falls off a cliff as newer, more power-efficient parts arrive. So, the structures have to be built around long-term contracts from credit-worthy tenants rather than around the salvage value of what's inside, which means the whole edifice depends on those contracts being honored by companies whose own cash flows are, as we've seen, under more strain than they were. Which brings us to the structure doing most of the work, and it's the part worth slowing down for: the special purpose vehicle. An SPV is a company created to do exactly one thing. In this context, it's set up to own a specific data center. The SPV borrows the money, builds the facility, and signs a long-term contract to lease it to the technology company that wanted it. Crucially, the borrowing sits on the SPV's books, not on the balance sheet of the household name company using the building. There are legitimate reasons to do this. Lenders like it because their claim is secured against one identifiable asset with one identifiable revenue stream rather than against a sprawling conglomerate. It lets a project be financed on its own merits. It's standard practice in energy and property, and nobody finds it sinister there. It also has an effect that is convenient in a different way. A company can commit to tens of billions of dollars of construction while its own reported debt looks comparatively restrained because the borrowing lies inside vehicles that are its partners rather than its subsidiaries. The obligation is real. Those lease commitments have to be honored. But it is disclosed differently, and a reader glancing at the balance sheet gets a tidier picture than the underlying commitments justify. So who actually holds the risk if this doesn't work out? Follow the chain to the end, and it's you. Private credit funds raise money from pension funds, insurance companies, sovereign wealth funds, and endowments. Investment-grade bonds sit in bond index funds, in target date retirement products, in the default option of workplace pension schemes. Almost nobody in that chain made a decision about artificial intelligence. They chose a retirement plan. There's a further twist that makes the revenue harder to read than it looks, which is how much of it travels in circles. Chip suppliers have taken stakes in the companies buying their chips. Cloud providers have invested in model developers who then spend that investment buying cloud capacity from the same provider. Each of these arrangements has a perfectly defensible commercial logic, and none of them is improper. But when a supplier funds its own customer, the resulting sale is weaker evidence of independent demand than an ordinary sale would be. And independent demand is precisely what the debt is being underwritten against. The rating agencies have noticed the shape of all this, and their commentary has grown steadily more pointed about leverage rising faster than earnings in the sector. That matters mechanically rather than reputationally. A downgrade raises the cost of the next round of borrowing, and some funds are obliged to sell holdings that drop below a threshold. Credit conditions can tighten without anything dramatic happening in the underlying business. That's the genuine difference from the dot-com era, and it's the reason this deserves attention rather than alarm. Dot-com losses fell overwhelmingly on equity holders, people who had knowingly bought speculative shares and understood they might lose everything. Debt changes who is exposed, and it changes the order in which people get hurt. The closer parallel is the telecoms build-out of the late 90s, which was also financed with enormous borrowing against confident forecasts of demand, and whose bankruptcies took years to work through the credit markets after the equity story was over. The specific thing to watch is not whether AI is useful. It plainly is. The question is narrower, whether the revenue arrives on the schedule the debt assumes. These facilities are financed against long-term contracts, and those contracts are underwritten by an expectation of how much computing the world will be buying in 5 and 10 years. If demand grows more slowly, or if efficiency improves faster than expected, so the same work needs less hardware, then the buildings still exist, the loans still come due, and the lease payments still have to be made out of revenue that didn't show up. There's a version of this that ends perfectly well, and it should be said. Demand may simply grow into the capacity, as it eventually did with fiber. The companies involved are among the most profitable on Earth and have real cash flows to service real debt. Nobody is lending against a business plan sketched on a napkin. But the honest description of what's happening is this: a set of companies that spent a decade as the safest, cash-richest businesses in the world have quietly become among the largest borrowers in the world, using structures that make the scale of it harder to see, funded by savings belonging to people who were never asked. Which leaves a question worth carrying. When the money stops being the company's own, who is actually making the bet? And who finds out last?